So you're thinking about whether VFV or VOO is the right fit for your portfolio. They both own the S&P 500, giving you exposure to the 500 largest companies in America, but one of course trades in Canadian dollars, the other trades in USD. Let's go over 3 factors that I think you need to consider to help you determine which is the better choice for your portfolio. Let's break these down on a side-by-side comparison. Now, of course, with both of these funds, you are getting the same underlying exposure. So regardless of what you buy, you are owning the 500 largest companies in America. Just get that out of the way. However, with VFV, key factors, it trades on the TSX. It's traded in Canadian dollars. This is a Canadian product at the end of the day. And the MER, the management fee you'd be paying, is 0.09%. Now, contrasting that to VOO, which is the American version, well, this one trades on the New York Stock Exchange. It trades in US dollars, and the fee that you'd be paying on this one is 0.03%. If we were basing our decision solely based on fees, we would say that VOO is the logical choice to go with. However, it's unfortunately not quite that simple, because the next thing we need to talk about is currency conversions. And keep in mind that if you are a Canadian watching this video and you want to go purchase VOO in your brokerage account, well, VOO is listed and traded in US dollars. Now, for most of us who are working here in a Canadian economy, we're earning our dollars in Canadian accounts, we're funding our accounts with Canadian dollars, you have to convert your Canadian dollars into US dollars in order to purchase this ETF, and there are often costs or conversion fees associated with that conversion. Now, every brokerage is going to be slightly different, but let's say the average conversion fee here in Canada sits between 1% and 2%. That means you're going to be paying 1.5% to convert your dollars over into US currency just to take advantage of that slightly lower MER. Key point to note is that the conversion fee will apply on the way in when you go to buy this investment. You also may be hit with a conversion fee on the back end when ultimately you go to sell this US investment, convert your dollars back into Canadian dollars so that you can go ahead and spend it in the Canadian economy. All that to say, when factoring in conversion costs, it makes purchasing VOO a little less attractive versus buying the Canadian counterpart, VFV, which again trades in Canadian dollars. Now, one big variable to throw into the mix, and you'll know whether this applies to you or not, is if you're an investor that has easy access to US dollars, whether that be through something like the Norbert's Gambit or some method of getting Canadian dollars into US dollars for cheap. Certain brokerage accounts are coming out with more attractive currency conversion costs and tier-based systems. Maybe you're someone who simply has a bunch of US dollars or gets paid in US dollars. That certainly can skew the equation here and lean you more towards VOO. Now, the next major thing to consider is where you'll plan to hold these investments, aka which account do you plan to buy these ETFs in? Because depending on which account you choose, the TFSA, RRSP, non-registered, FHSA, certain ETFs may be better suited for each. And particularly relevant to today's discussion is the topic of withholding tax on the foreign income we earn. In this case, we're talking about US dividend income, and depending on which account we situate these funds in, they may or may not be exempt from this withholding tax. In general, thanks to a tax treaty between the US and Canada, US listed ETFs such as VOO, they are exempt from withholding tax when held in the RRSP, meaning 0% of that income will be withheld at source. If that was held in the TFSA, a 15% withholding tax would apply. In a non-registered account, it is essentially, at the end of the day as well, 15%. And as we can see with the Canadian counterpart VFV, there's a standard 15% withholding tax pretty much across the board. So all else being equal, if you plan to invest in your RRSP, using a US listed ETF such as VOO is best practice when looking at it from the lens of withholding tax. To be clear, this 15% withholding tax is not applying to capital gains or growth that you experience. It's pertaining to the income that you receive, which in a case like VOO or VFV, these funds aren't necessarily known to be high dividend payers in general. So 15% of those dividends may be withheld. In my personal opinion, it's not the end of the world. This would factor in a lot more if you prioritize an income strategy and you're investing in funds like SCHD or even some higher income products at the end of the day. Now, the last point to discuss here before I share with you guys what I personally do in my accounts is talking about hedged versus non-hedged options. Because as a Canadian, when you invest in US stocks, you are exposed to fluctuations in the Canadian and US dollar relationship. Now, I actually did a video on this a couple years back, if you care to look to the channel and dig it up, which explains the relationship and how changes in the currency actually impact your investments. The key point for this video is whether you buy VFV, which is unhedged, or VOO, which is of course direct exposure to the US market, that does leave you subject to changes in the currency. What you can consider is a currency hedged option, something like VSP, or from BMO, ZEU. There's a number of options. These would aim to essentially strip out currency fluctuations. In my personal opinion, it's not something that I worry about as a long-term investor, someone who's investing over the next 20, 30 years. If you want to follow along with the dollar relationship, there are shorter term plays to be made, but as a long-term investor, it's not something that I personally worry about myself. Now, to share with you what I personally do, well, in my portfolio, I've opted for VOO. And there's a couple main reasons for this. For one, when I transferred over my brokerage account about a year ago, I had a big chunk of USD already sitting in the account, so I didn't have to worry about any currency conversion costs. Number two, I was also investing in VOO in my RRSP, my Registered Retirement Savings Plan. Now, as discussed, the withholding tax was not the biggest issue for me. This isn't a portfolio optimized for dividends, but following best practice, I had the USD. I thought, why not? Now, one key thing is that with my regular contributions that I put into my RSP, I do those in Canadian dollars. I opt to dollar cost average into ZEQT, which is a Canadian listed product, again, to avoid on those currency conversion fees. My VOO position is essentially just sitting there growing for me. In summary, when deciding between whether VOO or VFV is the right fit for you, factor in all of these different pieces and make the decision that works best for your portfolio. In general, if I had to sum it up, I would say default to VFV unless you know you have easy access to USD and you plan to buy it in your RSP. That's my personal take on it, but I'd love to hear what you guys think down in the comments below.